Well, it was a range-bound week that saw the Nifty and the Sensex end with cuts of over 1%. IT stocks were the biggest laggards. The index itself fell 5% for the week, marking its biggest fall since December of 2022. On this week's edition of the Editor's Roundtable, we have many questions that we're going to try and answer. Have the markets bottomed out? FIs have turned buyers in April. Are non-ESG stocks back in vogue? And we put the spotlight on the EV subsidies. I'm Sonia, and joining me are the editors Anuj, Nigel, Nimesh. Guys, the market was really range-bound, not too much action. I think the Infosys and TCS were at the center stage of the market this week, perhaps.
Oh, well, it was such a week that, I felt that, I aged a lot by the end. Honestly, it was a task to do, especially the closing shows this week, Sonia, because the market would just not move. Just when you thought about today, for example, just when you thought about, okay, finally there's a breakdown or a breakout, the market would immediately come back like a spring. It's almost like a magnet. You had a particular level and the Nifty kept coming back to it. It was that kind
I
of
don't think it was an issue with the market, Anuj. It was the fact that for the first time you had a full long week to do rather than all the long weekends
absolutely.
that we had.
It doesn't matter. It can be 7 days a week. If the market is really good, you enjoy it. But this week the market was very tiring. I'm telling you, Sonia, the volumes were low. It was tough to sort of get trading ideas for this week. It was almost everything. Traders would be complaining that, both sides their stop losses are hitting.
It was like the test match, right? And at least in the test match, we have a couple of sessions that are very good. And that at least makes the week. All the 5 days were so dull. Even on expiry day on Thursday, normally I'm sure, Anuj, you will be tracking that 3 p.m. move. It was missing. I mean, you had a 25 or a 30-point move, 17,630. I remember the level as well. And it just didn't get past that. So that sort of, just batting out the 5 days, it seemed, that sort of a market.
Oh, absolutely. In fact, let me just go through, Sonia, what happened actually. It was such a tight range, except the Monday. And Monday you had an event-driven week. You had the high and the low for the week were made on Monday. That tells you the kind of week that we had. You didn't violate Monday's range. All through the week, the market did not either cross Monday high or the Monday low, except today when you crossed it just by 20 points, the low, but immediately came back. The broader market outperformed though. That was a good point. But really the talking point was Infosys. It was a howler after a really long time, and the stock got punished and howled. 12% it fell. And I tell you what, it will have a ramification in the way that next shareholding comes out, because this week Infosys alone, my senses would have seen 4,000 crores of selling by FIIs. So I think that really was something. It pulled the other IT stocks also down. But and I had a very interesting conversation with Rahul today that why FMCG gained was because a lot of fund managers would have pruned exposure to IT and would have taken that to FMCG. So that's the reason the FMCG was doing well. IT was one stock, ITC rather was one stock, which really was dominating highlights. And the other thing which happened though was that FI short positioning was down significantly from peak. That's a good thing. My sense is next week is expiry week, and the market is very intriguingly poised.
So, for me, I think what Infosys said was very important. TCS spoke about clients deferring their orders. Infosys spoke about some cancellations as well. And that's why Infosys numbers were taken so badly, and hence, the 12% fall that we saw in the stock. But Anuj, you have some very interesting data on the FI numbers. Is there any evidence to suggest that FIs are coming back to our markets?
FIs are back with a bang, but with a rider. Okay. So, let me just go to the big wall and explain those numbers, because what, this number comes with a bit of a lag. This is April 1 to 15 data, the first fortnight of April, and this is the data we have taken from NSDL. So it's counted for every rupee, every dollar. And what is interesting is that we have seen the first fortnight buying since the November of 2022, in which the FIs net bought 8,767 crores. And in this fortnight, there were a lot of holidays. So really, this was the fortnight in which a lot of dollars came in Indian market. But this is where the catch is. Outsized amount of buying was there in financials, almost 4,400 crores. Almost half of total FI buying this fortnight was limited to financials, and that's outsized because the weight of financials in Nifty is 37%. And then there was buying in autos, 1,259 crores, and 14% of buying in autos versus weight of about 5%, which is very interesting. There are some other sectors as well where you saw some buying. IT, and those FIs will be lamenting it now, of course, 1,000 crores of buying. Metals, there was 670 crores of buying. There was buying in capital goods of 400 crores, but there was, a bit of selling in oil and gas. Now, why I'm saying that it was with a rider? You know what's very interesting? Three stocks really accounted for almost all of FII buying. And just look at the importance of these stocks. HDFC Bank, and I'm taking again this period, April 1 to 15, the stock rallied over 5% in this period, and it contributed 20% of Nifty's rally. The Nifty had a big rally. 20% of this was contributed by HDFC Bank. There was delivery based buying of 3.2 crore shares. And if you go by, this delivery volume of 5,300 crores, and then you take into account the FI holding as a percentage of free float, you arrive at a number of 2,000 to 2,500 crores of FI buying. Obviously, you have no way of knowing exact number, but this is an approximate. Now HDFC and HDFC Bank are more or less one stock because they're merging. HDFC rallied 6% in this period and it contributed 18% of Nifty's rally. So HDFC plus HDFC Bank accounted for 38% of Nifty rally. Again, delivery buying of 1.7 crore shares, which translates into, the next page would show you the kind of amount, 4,600 crores. Again, 2,500 to 2,700 crores would have been FI buying, going by the percentage of FI holding in the free float, and in HDFC, entire holding, of course, is free float. That was the kind of buying. And the third stock was Tata Motors. After a long time, we saw a big rally in Tata Motors, 12%. And look at delivery buying in Tata Motors in that period, 4.76 crore shares, which translates into a number of 2,100 crores. And again, by the same arithmetic, roughly 600 to 700 crores would have been FI buying. Now, these three stocks would have contributed about almost 90 to 100% of FI buying. And these stocks accounted for bulk of Nifty's gains. That's why I'm saying FIs are back, but with a rider. It was mainly around 3 or 4 stocks. It's not broad-based yet. Let's see if that broad-based buying happens or not, Sonia.
All right, interesting data, Anuj, just got updated, so, good analysis on that one. But Nimesh, what are you picking up in terms of dealing rooms?
Just to take Anuj's point forward on whether the FIs are back, looks like the FIs are back to some extent. And as you rightly pointed out, not on the broader markets, but selectively the large cap buying is happening for sure. That's the feedback from the dealing rooms as well. I guess from a markets point of view, while we spoke about a week of consolidation, Infosys down, IT index down to 5%. For me, the big takeaway for this week was the fact that all the consumption stocks, came back with a vengeance. A lot of stocks within the consumption basket, whether it's innovative companies, QSR names, all have been buzzing in this week. So that was a big theme, that the consumption names saw a bit of a interest from the investors as well. I think the other sector which did well was the pharma. This is the fourth week where the pharma is relatively outperformed, and at the index level itself, the index is up almost 10% now, and individual stocks have rallied between 15, 20, 30%. So pharma has stood out for me this week, but the bigger theme was the fact that the consumption names saw a bit of a bounce back. I guess among all this, the big large cap name to focus is ITC. It's hit a 52-week high today, been a big so ITC is not the stock of the week, but stock of the month. In fact, it's been a stock for the last 2 years now, and from a low of 204, it's now hit a high of 405. So big move in ITC, and that's been one of the consumption names which has done really well. So I guess a lot of that FI money could also be attributed to ITC to some extent in this week's big move across consumption names as well as in ITC.
Absolutely. In fact, let's do one thing. Let's invite our guest now. Joining us on the show is Pankaj Tibrewal, Senior Executive Vice President and Fund Manager Equities at Kotak Mahindra AMC. Pankaj, hi, good evening. Thanks a lot for joining us. Your thoughts on this week's big price moves? IT was down and FMCG was up. Your thoughts?
Hi Anuj, good to see you on the show after a very long time.
Good to be here.
On the IT side, I think we have started to get a little bit more constructive post the price fall. And I think markets were completely surprised. But a common thing which was seen in both the top two IT companies was the weakness in North America and the inflexibility on the margin lever side. Going forward, I think for valuations to sustain and for forming a constructive view, people need to take a slightly medium to long-term view on whether this is just a near-term problem or it's a medium-term problem. Our view is that the cloud adoption still is just 30 to 35%, and it will at least take next 2 to 3 years before the entire workload can be moved on to cloud and reach about 60 to 70%. So I think this correction can provide a good opportunity over the next 3 to 6 months to start increasing the IT weight. And also, if you look at IT profit pool as a percentage of total profit pool, it's come down from 14-15% to 9%. During the tech bubble, we saw that coming down to 4-5%, which we are not expecting. So I think somewhere between 8 to 9% profit pool as a percentage could be a good point to start at least cutting your underweight and moving towards neutral. And at some point of time, overweight, provided there is not material deterioration on that. On FMCG, I think there is a case to be made. What we have been saying.
Pankaj, hold that thought on FMCG because, I want to take this discussion forward. But after Nimesh put some data on board, so ITC was the big stock that hit an all-time high this week. And we are now increasingly seeing firms with lower ESG scores finding favor with investors. It's a very different ballgame of what we saw last year when ESG was the flavor of the market. But tell us, Nimesh, what is the data telling you?
Surya, so we all talk about ESG and the ESG funds and all. In fact, it's been in the fashion for the last decade now, right? But now if you look at for the last couple of years, and ITC being a classic example, hitting a new high, I've looked at the data and, it's very interesting. A lot of the non-ESG stocks are now back on the investors' radar. Let me just go to the wall and explain as to why I'm saying this, So the big thing is, are we seeing a dialing down of the ESG discount? That's a big discussion point. Now, look at the data and that will explain you why I'm saying this. The non-ESG stocks are back on the investors' radar. ITC has pipped HDFC and has become the 7th largest firm in terms of market cap. So that shows the kind of move you've seen in ITC for the last 2 years. In fact, just look at the overall data of ITC as well. ITC's FI holding has also gone up in the last 2 years from 12.5% to 14.5%. So there has been a big move as far as the holding in ITC from the larger FIs is concerned. Even if you look at the other data, ITC is one stock which is part of that big ESG basket, but that's not the case at all. It's actually moved up from 207 to all the high of 409 now. So almost a 100% up move in the last 2 years in ITC stock. But if you look at, I've just looked at the Nifty 50 companies and companies where there has been a high ESG concerns. And look at the stocks now. HDFC Life, the FI holding has gone up from 25.5% all the way to 30%. Power Grid stock, the FI holding has gone up from 28 to 32%. Same is the case with NTPC, 12% to 16%. In L&T, the stake has gone up from 22 to 24%. So there has been a big move in holdings of this, these companies. Even Bharti Airtel, ITC. I spoke about ITC, but look at Coal India. Coal India and ITC are the two big names among the ESG basket. Even there, the holding has gone up from 6.5 to 7.5%. So there has been a stake hike in Coal India as well. So this is a Nifty 50, but not only Nifty 50. Even outside of Nifty 50, there has been a big move, and FIs have increased the stake in a lot of stocks. The first stock that stood out for me is GNFC. The FI holding has gone up from 10% to 20%. That's a big move as far as holding is concerned. NCC stake has gone up from 13.5 to almost 20% for FIs. KNR Construction again from 2% to 6%. Insecticides India has gone up from 4.5 to 6.5. So there are a lot of these mid-cap companies as well where FI holding has gone up despite the low ESG score. Garden Reach is one name, Ratnamani Metal is the other name, J Kumar is another stock where the FI holding has gone up from 8.5 to almost 10%. So this is what the real picture says. While we speak about ESG, the non-ESG stocks have done well. In fact, this is not an India phenomenon. Even if you look at globally, things have really changed. The ESG funds have witnessed outflows for the first time in a decade, and that outflow is close to $400 billion. And that's the Reuters data that I'm quoting. And it also says that there is a change of heart among the global investors. So even if you look at the performance of ESG funds, for the first time, the ESG funds have started underperforming the non-ESG funds. So that's clearly the focus that funds have started moving back to non-ESG companies, and that explains the move in ITC. That explains the fact that even in Coal India, the stake of FIs have gone up. And there are a lot of nifty companies where the low ESG score is low, but the FI holding has started going up, and that shows that the focus is back on non-ESG companies.
Okay, thanks a lot, Nimesh, for that. In fact, Pankaj, you were making this point about FMCG, about ITC, right? But it's very interesting, the data that Nimesh put out. ESG funds, which were the darling of the market maybe 2 years ago, now have suddenly lost favor. How do you tie that in with ITC and the fact that it has hit an all-time high? Are you bullish here?
Sonia, we can't comment on stock specific, but just to give you a flavor on FMCG, I think there are two major trends one should watch out for. One is the gross margin expansion. Last 2 years, most of the FMCG companies have been deeply impacted right from either 5% to 10% on gross margins, led by raw material costs. Most of the companies are seeing reversal on that, and we track raw material index for each and every company. And I can tell you that over the next 3 to 4 quarters, you will see meaningful shift in the gross margins. And a lot of them will not pass on the benefit to the end consumer. And hence you will see margin expansion, which could be disproportionate at the bottom line level. The second thing, if you closely watched on the updates by few of the companies, some of them have told that rural has started to turn at the margin for good. And I think we brought on this data that in the election year, FMCG actually does well because the money gets spent at the ground level. And 6 months before the election and 6 months after the election, this is one sector which always does well in an election year. So my sense is that burst of the volume growth is priced in. Margin recovery is likely to be there this year. And hence you can see a decent earnings growth for the sector, which has not been the case for the last 2-3 years. And hence valuations have stagnated. Once earnings growth starts coming, at least the stock prices will track the earnings growth of the sector. And hence I think case to be made for being in FMCG after a long time.
Okay, a case to be made for being in FMCG after a long time. The other big story in the week gone by was the possibility of the electric vehicle industry bubble bursting. Now, I'll tell you why. Reports are indicating that the government is not looking at extending the FAME subsidy or the faster adoption and manufacturing of electric vehicle scheme subsidy. And if this is not extended, then prices of EVs will go up and demand could get hit quite a bit. In any case, EV adoption has not been as fast as perhaps what the government was expecting. Now, if you remember, there is an ongoing probe and subsidies of 13 electric vehicle players, including Hero Electric and Okinawa, have been on hold since May of last year. Now, IFL put out a note last week, in the week gone by actually, where they said that the EV bubble could burst in the next 12 months. The past 6 months have seen a sharp rise in TVS Motor EV volumes and a fall in the sales of Hero Electric and Okinawa. That's because the government has put on hold the subsidies for Hero Electric and Okinawa. Now, if the subsidies on the other companies are also put on hold, then what happens with those, with their earnings? And TVS Motor assumes importance here because if you look at it, TVS Motor is now perhaps the most expensive stock in the OEM space in India. It's currently trading at 30 times FY24. Another concern is derating of the valuations of TVS Electric. Now, TVS Electric reports indicating that there is a valuation of almost $3 billion for the whole, entity. And Carlyle and Goldman Sachs are looking to pump in about $300 to $350 million. Now, if EV subsidies are rolled back, then what happens to that, business? So there's a case being built perhaps for some of these stocks that have high valuations to cool off over the next couple of months. But the bigger question we're asking is whether subsidies are needed at all to grow a sector. We had a chat with Bajaj Auto's Rajiv Bajaj, who said he is not a fan of subsidies. He believes that the withdrawal of the FAME subsidy will not have a big impact in the longer run. Listen in.
I am not a fan of subsidies of any kind. And I do not think India is going to build a EV future based on subsidies. Subsidies going away, in my view, should not really have that big an impact in the long run, because the future of EVs in India will be built on the back of sound strategy, not subsidy. Subsidy is not a strategy, and in my view, subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
Well, it's time to slip into a short break, but coming up, have the markets bottomed out? Well, we'll take a look on the other side. You stay with us.